Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what is driving investment markets and what to look out for in the days and weeks ahead. Now, what a week we've had since last week. Now, some of the biggest macro themes out there had some sort of resolution or movement. So let's just start off with the trade war. At the end of last week, after last week's show, we had China and the US in trade talks, and then there was a big fanfare at the end of the week as Trump came out to say they'd actually agreed a trade truce, a deal. As it turns out, the detail of the deal is very sparse. What we've got is a kind of semi-deal, a mini-deal as it were. And the deal is really only some ideas that they've got. There's no real detail on it. It's an agreement in principle. Think of it like a mortgage. You get an agreement in principle. All that means is that a lender is going to give you some money. It doesn't mean they will give it to you. It doesn't mean you're actually going to end up buying a house. It's a bit like that. So what we've got is America touting an agreement in principle, nothing in writing, no real hard details other than the idea that China might buy a few more agricultural products and there may be some more discussions going forward. But the market loved it. So equities pushed higher, which I'll come on to later on in this video. So it seemed like there was a deal, but then China came out afterwards to suggest that there wasn't really a deal and there's got to be some more talks in the future before we get something much more concrete. But it was something very positive. Then we had Brexit. Now, by the time I finish this video will probably be dated because the Brexit is really moving at quite a speed. How have we got a deal between the UK and the European Union? Before last weekend, it seemed to be dead, but then suddenly we had some movement. Boris is running around trying to agree some form of deal with the European Union. If you look at the pound, particularly against the dollar, if you look at that exchange rate, it is yo-yoing like anything. And again, I'll come on to that later on in the video. So Brexit, we may have a deal by the time I finish this video, we may not. But if you look at where we are compared to this time last week in terms of the actual detail, we're not really any further forward, yet we've seen some of the biggest moves in the pound that we have done in years. So the pound has strengthened on the idea that we might just be about to have a Brexit deal. So that is something also positive. You may remember last week I talked about the Federal Reserve in America starting to say they may start a QE, a quantitative easing program, but not a quantitative easing program. Don't call it that. Jerome Powell, the chair of the Federal Reserve, doesn't like anybody saying it's more QE. But in all sense of purposes, it does seem like QE. Well, by Friday, again, they not only had discussed it, they pushed the button on it. So we are now getting more QE in America. And that can only be good for equity markets if you look back at history. And of course, we've had earnings season start. We're only in the early days of it. But on the first couple of days, we had 11 companies in the S&P 500 report and only 2 missed expectations. So that's been very bullish. Judging by what I've just told you, everything is awesome. But of course, if we go back to the fundamentals, the IMF, the International Monetary Fund, downgraded their forecast for 2019's economic growth for the entire world. It's down to 3%, which if you go back to 2018 when they were making these forecasts, it should be around 3.9%. So that's been downgraded. We had some dire US retail sales, which isn't positive news for the US economy. And of course, we've had some weak inflation numbers out of the UK and the Eurozone as well, which is very deflationary. So if you look at the fundamentals, it's not particularly great. We've not made any great strides to a sustained recovery as yet. So what does this mean for markets? Well, if you are a UK investor, you'd be wondering, well, what's going on? Because on the one hand, you can look at the S&P 500 pushing back towards all-time highs. We are now out of that 100-point range I was talking about last week. We are now around the 3,000 level. The market's looking a little bit overbought, but we're pushing higher. If you look at the FTSE 100 though, it's largely missed out on all of this sort of bullish sentiment. If you look at bond markets, we've had a terrible week. So we were down about 1.5 on the US 10-year Treasury yield. We've gone up to about 1.79. So yields have risen, meaning bond prices or Treasury prices in this instance have fallen. We've seen that across the whole bond space. The VIX, interestingly, was still very high. It was still above that key 15 level, and we've just gone below that finally. So people do think, or equity markets definitely think everything is awesome. But if you're a UK investor, you'd be looking at your portfolio and probably thinking, well, everything's going completely wrong. Because what's happened, as Brexit is looking like we may get a deal, the pound has rocketed. If you're an 80/20 investor member, I did warn about this in my technical analysis piece about a month ago, of the possibility, even though at that point we were down at $1.23, this is the pound dollar exchange rate, that there was a potential that the pound could rally very strongly and very aggressively if there was a whiff of a deal. And the idea that we were going to avoid a no-deal Brexit could send it up to over $1.27, $1.28 and towards $1.30. Well, that's where we find ourselves. So that means if you have any overseas exposure in your portfolio, no matter, even if the equity markets were rallying, the exchange rate would mean that you would have lost a lot of money this week. So I say a lot of money, but you would have been down a few percentage points because of that exchange rate. Of course, with bond markets tumbling, that would make your global bond funds, even the losses on those, even larger. So we can expect huge amounts of volatility in the pound exchange rate, which will have a big impact on the value of your portfolio. So you may want to avoid making any sudden decisions on your portfolio based on the pound and pence value of it in the coming days. But also for UK investors, don't forget that the FTSE 100 has a huge exposure to overseas earnings. So that means that the FTSE 100 hasn't enjoyed the rally because as the pound's got stronger, it's held the FTSE 100 back. So therefore the FTSE 100 hasn't bounced above that key 7,350 level I talked about last week. Interestingly though, if you look at the small caps or mid cap stocks, so if you look at the FTSE 250, we saw that rocketing this week. I mean, at one point on Monday in particular, it was above about 3% in one single day. We're seeing the FTSE 250 rallying because a Brexit deal would be good for the UK economy, which in turn would therefore be good for the FTSE 250 because those kind of stocks and companies have more exposure to the health of the UK economy. So where we are as DIY investors at this point in time, it's a kind of hang on to your hats scenario. So we've got Brexit. What's going to happen in the coming days is going to have a huge impact on investment markets. What happens with the trade deal, whether it unravels once again or whether we get some more concrete details is going to have a big impact. And of course, earnings season has only just started. So until next week, I think it's going to be a very different picture to where we are today. So that is it for this week on Damien's Midweek Markets. You can contact me in the usual ways. Damien@moneytothemasses.com is the email. On Twitter, Money to the Masses with the number 2, Instagram, and of course in our new Facebook group, which you can find by going to facebook.com/groups/Money to the Masses. And don't forget to subscribe to our YouTube channel.